Do you ever wonder why some traders are consistently profitable while others just keep blowing accounts? The difference comes down to whether or not they truly understand supply and demand, or if you're just drawing random lines on your chart with no structure. I've been trading options full-time for years, and the biggest shift that happened in my own journey was when I stopped guessing and I started building every trade decision based off zones. In this video, I'm going to show you step by step how to identify supply and demand zones, how to draw and mark them up on your chart, and how I trade them with confidence. And yes, we will go on the charts together so you can see exactly how I do it in real time.
How to identify supply and demand zones? Let's get right into it. So there's two types of supply zones. It's patterns. It's 3 candlesticks. So it's a drop, base, drop, supply zone. This one's a continuation pattern. And then we have a rally, base, drop, supply zone. And this is a reversal pattern. So this is what it looks like. The first one, drop, base, drop. It's just 3 candlesticks. It's very simple. You don't have to overcomplicate it. What I mean by drop, base, drop is we want one strong, aggressive red candle, a small body basing candle. For the drop, base, drop, it must be green. And then we want another aggressive drop candle following the basing candle. My rule of thumb is you want the body of the drop candle after the basing candle to be double the size of the body of the basing candle. The body of the drop candle should be double the size of the body of the base candle. And that's how you'll know if it's aggressive enough to be a drop, base, drop. It's a green basing candle, 2 red candles next to it. It's a 3 candlestick pattern, and I'm going to talk more about the nuances, but essentially a drop base drop, it's the continuation of a selling trend. It's the continuation of a downtrend. You'll identify this when price is going into a downtrend, and it signifies that sellers are remaining strong. They come in very strong. There's a very small base period of imbalance, a balanced area, but then we imbalance again. So it's very simple. You don't have to overcomplicate it. That's exactly what the pattern looks like. And then in this lesson, I'll just show you like more examples so you guys could get it. And then the next one is rally base drop. It's also simple. Here, I'll zoom in a little bit for you guys. This is what it looks like. It's a 3 candlestick pattern. We identified on the high time frames. So you can see here, this chart says 2 hour. This chart says 1 hour. So supply and demand zones, it's a pattern that becomes our level of interest, and then I'm going to go into exactly how to mark it up as well too. But just identify these 3 candlesticks. This is the reversal candlestick pattern. So it's a rally, base, drop. The same idea is that we have 2 aggressive candles on the outside of the small body basing candle. So this is a reversal pattern. This pattern indicates a potential reversal of the trend. So if price was going up, it's saying like, hey, price is going to start going down. And you can actually see after this form, price went down a decent amount towards the previous low. And when price retested where this pattern formed, price also rejected. So both of these patterns signify selling pressure, and when these patterns form, they leave over sell orders because there was an imbalance. Basically, I have explained this in the course, but to explain it to you guys again, the reason why we're looking for such big, strong, aggressive candles, and then a really small candle, and then another really big, strong candle, is that price didn't stay at this price for a long period of time. It only stayed there for a short period of time, and it didn't move a lot either. And then there was another aggressive movement. So since price wasn't there for a lot of time and price moved away from that area quickly, how the stock market moves is price is going to want to go back there and retest it because price didn't spend a lot of time there. And the thing is, when price doesn't spend a lot of time in an area, there could be leftover sell orders. So I really helped you guys visualize that in the last lesson. I was explaining to you guys like these are supply and demand zones. There's the leftover orders there. Today's lesson is not so much about that, but I do want you guys to have that background knowledge if you guys haven't seen it yet. So we're talking about identifying, seeing the patterns, getting used to them. So firstly, how to identify a supply zone. So you're going to look to the left of your chart For example, like here, you found to the left of your chart and you're gonna look for the pattern. So my rule of thumb is when you see a tab right here, this is actually a really good tip that helps a lot of my students, is if you open up any stock and you see a tab right here, this tab, that shows the current price. So if you're looking for supply zones, all valid supply zones are gonna be above the current price only. Above the current price only and to the left of current price. So if you're looking for valid supply zones, you're going to look at the current price and you're going to look at these candles here above current price and to the left. So for example, one of the patterns I just showed you is a rally base drop supply zone, and price drop from there. So that's just the one tip on identifying the supply zones. These become our level of interests. So I'm explaining to you now how to mark them up, because when price retests them, then that's where we want to take our put. So when we retest the supply zone, we want to take a put. We want to bet that the stock's going to go down. So here, this is our level of interest. So how you mark it is important, and it's specific. So zones, supply zones, start from the bottom of the body of the basing candle and it extends to the top of the wick. So this is very important. It's very specific. And this is a reason why I personally like using the supply and demand strategy, because it's more specific than support and resistance. So for example, if I'm going to identify a zone, I want to make sure I mark it correctly. And that's typically what I see with supply and demand zones. You can get some quick reactions or, find daily trade setups. You start your zone from the bottom of the body of the basing candle and you extend it to the top of the wick. You expect the rejection to happen from the bottom of the price level, but you give it a little bit of room, like you make it a zone. You expect all the selling pressure to happen in that range, because we understand that sell orders are distributed at multiple prices, not at just one price point. And that's why we don't really go with support and resistance, and why a lot of people get fake out trades with support and resistance on day trading. And this is why I like supply and demand, because we know okay, this whole range, this is selling pressure. All we need to do is time our entry as a day trader. Or as a swing trader, you focus on your risk management. So for the base drop, it must be a green candle. For the rally base drop, it must be a strong green candle. Any color base candle, a strong red candle. So it doesn't matter about the color of the base candle and the rally base drop. It matters more about market structure and where it's forming. Okay, this is happening at the height of the range, where all the selling pressure originated. And then look, this is where all the buying pressure originated. Price went up. So that's our demand zone. Price came back up to it. Price rallied again. This is where all the selling pressure originated. Price came back up to it and price rejected again. So this is how price actually reacts in balance ranges. It'll go from the demand zone to the supply zone. It'll go to the supply zone, right back to the demand zone, and it'll go from the demand zone right back to the supply zone. In balance ranges, it'll move just like that. And what will form in the middle is rally-based rallies and drop-based drops that will help you get more day trade type opportunities. We trade only after and if price returns to the origin zone. So I trade the retest of the supply zone. That is just confirming that price is reacting from the zone. That's all it is. So remember, the root of it is what we're looking at on the high time frame with supply and demand zones. So here's an example of one supply zone again, a rally base drop. You drop from the bottom of the body of the basing candle to the top of the wick. This is on the 3-hour chart. So that's a supply zone example. I'd mark this up. The reason why I'd mark it up is because price is close and it's fresh. So if there's gonna be a rejection, it's gonna be from here, and then I'm gonna take a put. We're not going to talk too much about planning right now from the zones. If you guys want to jump into planning, I have some good lessons here, and the best one that I recommend to you guys that goes really in depth is here, how to actually select a plan after you mark their supply and demand zones. So there's a supply zone example. Here's another one. Now we're looking at the 3-hour chart on Netflix, and you can see here is the same pattern. Rally base drop. You could actually see the first time it rejected, it went right into the demand zone. And then the second time it rejected, it went a little less. So this is a pattern you'll see sometimes. Here's even a supply zone rejection. So there's a very strong rejection the first time, but typically the second time you see a test, it's going to have a slightly weaker weaker one until there's a breakout, especially if the trend is shifting, but there was a rejection from the supply zone. So that's one example. Here, that's the 1 hour chart, drop base drop. So if we're looking for the continuation of the downtrend, I'll identify supply zone close by current price, and I'll look for the rejection there, and I'll target the demand zone below. So you could actually see like this whole downtrend happening. There was a supply zone that formed there. We retested and we rejected. There was this rally base drop that formed. We came back up. We retested and we rejected. This drop base drop formed right there. We came back up. We retested and we rejected. It was also kind of like a support and resistance. So I moved it like that. But look, rally base drop, retest, reject. We come to a demand. We retest, we reject. So that's typically what happens in trends. If it's in a downtrend, it will pull back up into supply zones, and you look for the rejection of the supply zone and you target a demand zone below. But sometimes, given that, if we're in a downtrend and we're making lower lows, of course demand zones are going to be broken. So for example, here, we'll get into it, like I think the next couple slides we'll talk about demand zones, but sneak peek. This is a drop-based rally. This was a demand zone. Price rallied the first time it was tested, but then it broke below. So that happens in downtrends. So typically the first test will be the strongest. Then the next test will be a breakout. If it's counter trend, if it's going with the trend, usually there'll be like a strong first, second, and third test if it does happen. So just some things to keep in mind. Let's see. All right. So one more example of supply zones here, looking at the 1 hour chart. You can see I label these with the time frame. So here there's kind of a rally base drop. That's what I ended up drawing there. Also here there's a rally base drop. We retested it and then we had a very strong drop. So even here, this formed that day, the next day we retest and there's a very strong drop. So these give you like I like to mark them when they freshly formed. Look exactly right here. Drop, base drop. We retest 2 days later and there's a very strong drop right into the demand zone. So there's a couple examples for you guys about supply zones. Not overcomplicating it at all. These are the patterns that I look for every single day, and literally I trade off with these every single day. So here's one example. Rally, base, rally. So it's not perfect, but you can see the rally candle is somewhat double the size of the body of the base candle. So the body of the base candle, the body of the candle that follows it, is mainly what I pay attention to. Ideally, we don't want to see any wicks, but what is happening here is this is an uptrend on the S&P 500, and this is the all-time high, and this was a little supply zone that had formed, so there was a little rejection from that supply zone. But since we're in a really strong uptrend at the all-time high, I had marked the continuation pattern of the demand zone, and look what happened. The next day, price retests it and rallies to a new all-time high, breaks above the supply zone. So this is the continuation pattern of the uptrend, where it breaks above, like, a little consolidation. You can kind of tell it, like a bull flag is forming. So you could also combine it with your chart patterns. So rally, base, rally. Identifying demand zones is opposite than supply zones. So it's opposite in most ways. So we'll get more into that. But it's a continuation pattern, a continuation of the uptrend. It shows a price increase, small consolidation, then another price increase. So basically, the base candle, how we think of it, is that's where demand builds up before pushing price upwards again. So we just want price to come and retest it. Those are where all the buy orders were building up. We enter our call there and price rallied. Here's the opposite pattern for the other demand zone as well. So we got our continuation pattern, rally-based rally. The nuance of the rally-based rally is that it must have a red basing candle. So that's specific for rally-based rally. That's specific for drop-based drop. So drop-based drop is red, green, red. Must. So always you want the opposite color in the middle to make it more clear. For the reversal patterns, the basing candle doesn't need to be a specific color. What matters more is that you have wide bodies from the rally and the drop candle, and a narrow body from the base candle. That's what matters more. So here, this is the opposite pattern. Drop, base, rally. The same day, price retested and rallies from there. And then the next day, price retested and rallies from there again. You get many opportunities from these supply and demand zones, and I see them every day on like every ticker. There's so many opportunities with these. So for the hack for demand zones is I want you guys here, Microsoft or Tesla. There was actually a strong move on Tesla recently. So all the valid demand zones would be exactly from this current price down and to the left. If there was a demand zone like here, it was broken, so that's not going to be valid. So we look here like that for all of our valid demand zones. Rally, base, rally, green, red, green must be that pattern. For the supply zone, drop, base drop must be red, green, red for the drop, base drop and the rally, base, rally. Those are continuation patterns. For our reversal patterns, what matters more is just the fact that there's a drop, base, rally. Looking at the market structure, drop, very small period of time left here, and then a very strong rally. Like you could tell there's an imbalance here. So then you find your candlestick pattern. Drop, base, rally.
So now you've seen exactly how I draw supply and demand zones. If you're brand new to trading and want a complete walkthrough from the very beginning, the next video you should watch is how to start options trading as a complete beginner step by step. In that video, I'll take you from zero knowledge all the way to placing your very first trade the right way. That video is linked right here on the screen. Go ahead and click it and I'll see you in the next one.